The Fed just cut rates again. Here's what you need to know. Fed just cut the federal funds rate by 25 basis points, bringing it down to a level between 3.5 and 3/4%. Now, this could help bring down short-term borrowing costs. It could maybe even help the labor market. But when it comes to long-term fixed rate residential mortgages, I think this is a big nothing. Bond yields went down a little bit today, but they're still up from where they were a couple of months ago, and mortgage rates are still sitting at about 6.3%. And that's because until we have a clear line of sight of whether or not we're entering recession and whether or not inflation is going to improve, bond yields are probably not going to move very much, and neither will mortgage rates. On top of that, the Fed is really tempering expectations for further rate cuts. As you can see here, the median federal funds rate will end the year at about 3.6%. Next year, they're expecting the median federal funds rate to be only 3.4%. The year after that, just 3.1%. So meaning they're really not expecting to cut rates much more over the next 2 or 3 years. Of course, that's just an estimate and they could change their mind, but it just shows that they're not expecting a lot of cuts in the future. So although I hope it helps lower short-term borrowing costs, this isn't really going to change much in the residential housing market. As I've been saying for months, as an investor or a homeowner, you cannot count on rates going low. If you're going to participate in this market, you need to accept that rates are what they are and make decisions about whether you want to be in the market based on the realities of the market and rates as they stand today.